I'm joined from the Frankfurt Stock Exchange by the Global Head of Equity Research at RCM, Gunnar Miller. Thank you so much for speaking to us. So, as we were hearing from our reporter on the ground there, European finance ministers creating a rescue fund to sell bonds. Is this going to help stabilize markets?
Well, it is interesting how austerity measures are usually driven by crisis. And just a few months ago, for Chancellor Merkel to have proposed a cut of 15,000 public sector jobs probably would have been unthinkable. So in some ways, the crisis is actually having the politicians put things back on track. Now, whether or not they'll respond to Geithner's call to stimulate consumer spending, might be showing up in the tax policy where, whilst they're not proposing tax cuts per se, they're not proposing any individual tax increases. So I think markets should view this as an ongoing stabilization of the social political drivers of the economy.
It is interesting that you mentioned comments there by U.S. Fed Chairman Ben Bernanke. He's been saying the U.S. recovery is on track, that it's intact despite disappointing jobs data that we've seen. I mean, is the evidence there really to support what he's saying?
Well, we think we're in a bit of back and forth. It's interesting this morning how you're reporting on what's viewed as disappointing German export data, whereas yesterday April's factory orders were up 2.8% in Germany. And so we think we're at a point now where the economic data are oscillating. They're continuing to show that the stimulus measures are functioning, but it's not all going to be up and to the right for now, as markets have shown us. We've had a 10 to 15% correction, which after a 70% increase off last year's lows is pretty impressive, but it shows how markets aren't still 100% convinced.
And of course, the interesting thing about the latest export data to come out of Germany is the fact that many analysts were saying that a weaker euro would actually boost exports, and we've seen the euro hit fresh lows against the dollar and the yen over the past 24, 48 hours.
Well, I think there's a bit of a lag effect on this. Think about it. The factory order and export data are trailing into April, and we really did have quite a precipitous drop. We actually believe that the weaker euro is a positive for European export economies and notably for Germany. And we actually are slightly bemused by the anchoring effect that's occurred. The ECB's targeted, I believe, 115 against the U.S. dollar for the euro since inception. And allegedly, European exporters wouldn't be competitive at anything above 120, 125. They seem to make it all the way to 150 without any difficulty in increasing their competitiveness. So now that it's dropped back again to sort of the 120 level, we think that we'll see a real leverage effect.
Okay, so very briefly, just tell us a little bit more about your investment strategy right now in the current environment.
Well, we've actually we viewed the current weakness in the euro as a positive, and we've actually moved tactically towards a larger overweight in equities. We still strategically are a bit underweight equities and underweight bonds, but tactically we think there's a real opportunity. We've had a pullback in the market, and we're concentrating specifically on European and emerging markets equities and paring back a bit on Japanese equities.
Well, thanks so much, Gunnar Miller.